The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a certified financial planner at Galileo Capital. Warren, good evening. We're talking about why uncertainty is helpful to successful investors. And I suppose we should start with the fact that if you look around right now, we've been talking about uncertainty this evening, there always seem to be reasons to avoid investing money. It can always look like a bad time.
Absolutely right, Stephen. And, if you just look at the people asking questions now around, will Trump be good for markets, or will Harris be good for markets, or what do we do with this BRICS thing? Is that sort of an anti-West move? And all along, there will be very good reasons for people to be fearful. And I think that those are those same emotions are actually the reasons why you will, as an investor, find great opportunities to buy very good quality assets at a better price. Because when everyone's optimistic and they all think everything's amazing, they're going to sell nothing, because they think every business they own and every share they own is going to be worth much more in the next months and years ahead. And so they're just going to hold on. And if you want to buy those, you're going to have to pay up an enormous amount. That's not the time to be a great investor. The time to be a great investor is when everybody's a little worried about what's going on and what's going to happen. And possibly some people are selling at the wrong price, at very low prices.
We need to talk about the nature of uncertainty, what exactly that is.
So I think a lot of the time when we look at stock markets, especially people that maybe are new to stock market investing, or often you find retired people have never paid attention to this. Their company retirement funds have taken care of everything, and suddenly they retire and they get this living annuity statement from their product provider, and every month it seems to be going up or down, and most of the time psychologically it just seems to be going down. And suddenly they become very wary of the roller coaster of stock markets. And so just understanding, number one, that the uncertainty that you see in the price of your investments is not really a reflection of actually what's going on. All that it's really showing you is kind of a temperature gauge of how people, and when you measure people in large groups, that's called markets. So how people are feeling at the moment, and sometimes as fast as every half an hour, every hour. So that roller coaster, Stephen, is by no means a measure of the value of investments or what your portfolio is going to do over time. It's just understanding that markets are fluctuating like mad in short periods of time. And so your job there is to look at this and say, okay, I see this, and it is a bit frightening. It is a bit worrying to see, does this carry on? And the answer is, it carries on in little waves, in small little moves. But over time, when you zoom out, things tend to go up. Things tend to rise in large, big cycles. And so understanding day to day, if you're going to track your investments every day or every week, you're going to see a lot of price moves. But the moment you start to look at your investments every 6 months, suddenly it looks a lot smoother. And maybe that's the first hint about what you should be doing.
And then the difference between risk and uncertainty. And I mean, often sort of one means exactly the same as the other, but I presume that's not the case.
Not at all. So to me, when you say, well, okay, explain what's a risky investment. A risky investment is, I put my 100 in, and in 5 years' time, it's still worth 100, or even worse, it's worth 50 or zero. And so that for me is a permanent loss of capital. And you might say, well, why is it so bad if you put in 100 and 5 years later it's still worth 100? You actually haven't lost anything. That's not true, because what's happened is the buying power of your money is a lot less over a 5-year period because of the cost of living. Cost of living, unfortunately, never goes down. It only goes up. So for me, that is risk. If you want to know what keeps me awake at night, it's not stock market prices jumping up and down over a daily or weekly period. It's actually that the buying power of my money is declining at a fairly consistent rate. And have I got investments that are going to, over time, grow faster than the buying power of my money is being eroded by inflation? And so for me, that's really risk. A share price or an index price or a unit trust price going up or down, from week to week or month to month, that's normal. I think the best analogy I can think of is it's very much like the tide. It's going to go out, and I know if I hang around a little while, it's going to come back again. And so all I need to do there is be patient. And so for me, risk is about what really will destroy the value of your capital. But buying Steinhoff and getting nothing for your money at the end, that's a permanent loss of capital. Buying African bank shares and then watching it implode, that's a permanent loss of capital. Buying the top 40 index and watching it go up or down, day to day, week to week, and then looking at it 5 years later and it's gone up 15% a year, so it's doubled. Gee, that's a good ride. But day to day, it probably looked really scary.
And then, okay, so that's risk. And then uncertainty is different. Uncertainty is something else.
Yeah. So what we want, all of us as human beings, is I don't know if you do it, Stephen, but I faithfully every night before I go to bed, I look at my weather app and I look at what's going to happen tomorrow. And then I start to plan what I'm going to wear. And when I wake up in the morning, I equally faithfully check the app again. And then I get up with relatively full confidence that I'm sure the app's going to tell me what's happening. But I live in Cape Town, which means that the app is wrong probably 50 or 60% of the time. And so I still look at the app, and actually, the most likely kind of predictor of weather is probably a coin, and I just flip heads for it's going to be better, or tails it's going to be worse, and that'll probably be more reliable than my app. But the reason I check the app is because I want some certainty. I want someone, in this case, my phone, to tell me what's going to happen to the weather today. And then I feel better because I've got some kind of certainty. And so that's the thing, is as human beings, we want to know what's going on. I can't tell you how many times people have asked me what the rand's going to do next week or next year. And the honest answer is, I don't know, nor does anyone else. But it's a very unsatisfactory answer for people. They want certainty, even if it's going to be the wrong answer. That doesn't help you if you're an investor committing real money to long-term capital growth. You need to look at this and say, I'm okay with that. I'm okay that actually these things are going to go up or down, and I don't really know what's going to happen tomorrow or next week or even in the next 6 months, because markets do that all the time. They go up or down in kind of really big patterns and really volatile moves, and that's normal. That's okay.
Your question for Warren Ingram tonight. We're talking personal finance. We're talking about embracing risk and uncertainty. Why uncertainty is helpful for you. 011 883 0702 and 021 4460 567. Strangely, very good time to have this conversation, Warren. So then, okay, how do you embrace uncertainty? What do you actually do? And you say, with diversification.
Yeah, so I think understanding that you can't get certainty, that's you need to make peace with that fact, and so looking around and reading articles or investment journals, hoping that some massively qualified, hugely paid analyst who's got thousands of awards has any kind of insight into what's going to happen in the next 3 months, you need to realize that's a false hope. What a great strategist or analyst will do is they'll give you very coherent reasons as to why something might go up or go down. I mean, they can do that. The only reason they give you a prediction, they don't call them predictions, they call them forecasts, is because we ask them to, not because they really want to. And so if you're humble enough to say, okay, myself as an investor and everyone around me as fellow amateur or professional investors, we can't really predict how things are going to unfold. Then what you need to do is say, let's take some money and we invest it because we believe our thesis is that, let's say right now, my thesis is that emerging markets are quite cheap. And I think over the next 5 or 8 years, I think emerging markets, including South Africa, are going to be a good place to invest your money. I think you're going to get good returns. However, I'm not going to put all my money into emerging markets because I'm humble enough to know, and maybe it's just been taught enough lessons by the markets to know that I could well be wrong. And so I'm going to put some money into the US, into Europe, into Japan, etc. And so spreading my investments far and wide means that if my thesis is right and emerging markets do well, then some of my money will grow. But if I'm wrong, then at least I've got money in some of the developed markets, which will then hopefully deliver better growth. So it's spreading your money across various types of investments, and then don't just buy shares, because what happens if shares have a dead decade? It's very rare. It does happen. America had a dead decade from the year 2000 to the end of 2009, and maybe they're going to have it again now. It's very possible. I don't know, but you need to make sure that you've got investments that are not only in the stock market. I know I love shares, so I talk about them a lot, but you need to own some government bonds. You need to own some property companies as well, and you need some cash just in case everything goes wrong. Then your cash is a great performer when the world's fallen apart. So that spreading of assets is your single biggest protection against uncertainty. It also helps you psychologically, because when markets start falling and your investments are going down, and you keep saying to yourself, don't focus on this, focus on the long term. It's quite scary when your let's say your stock portfolio is going down a lot. At least if you're looking at your cash and your bonds, let's say, or your property companies are holding their value somewhat, it gives you kind of an emotional stabilizer in addition to a financial stabilizer. So that diversification of investments, of geographies, of sectors, and everything else really helps you to kind of protect yourself against the emotional and financial impacts of uncertainty.
I was very interested in the geographic diversification. I made the point earlier in the program that, I think South Africans may well feel a little bit more certain about our future tonight than Americans do, which is an astonishing thing to say, and something you couldn't have said 10 years ago, I don't think. The point you're making is that you actually don't know what will happen anywhere in the world, which is why you have to geographically diversify.
I keep thinking about a place like Japan. 5 years ago, or we would have said, if you look at Japan from an investment point of view, they've got terrible demographics. They've got this very old and rapidly aging population. The young people are not having enough children to replace the people that are dying on the other end of the age spectrum. And so what you've got is kind of an upside down pyramid of very few young people supporting a very old workforce. And so at some point, the old workforce who will all go into retirement need to be looked after by young people who are generating income and paying tax. And if that doesn't work out, what are they going to do? And it's a real concern for many of the countries around the world where you've got shrinking populations, rapidly aging, and no replacement of young people. And so 5 years ago, I would have said, gee, that for me, that's not a prediction, but I mean, that's an absolute tidal wave, of bad demographic information. And I wonder what's going to happen. And 5 years later, they've done quite a lot of reforms of their stock markets. Japan's actually not been a bad place to put your money at all. And it seems like they've started to go against their long-held, views on immigration, actually allowing some immigration, which will change their demographic profile again. So the prediction would have been avoid Japan. And actually, that would have been a bad move. And so, the things that we believe are certain, in my core, I can't look at Donald Trump and think that he's good for any kind of humanity or any kind of trade or anything. But I could easily be wrong. He might be fantastic for investment markets because he slashes tax rates and he promotes internal trade in America and does whatever he needs to do. And maybe it works out. But in my core, I think that that's a really bad idea. However, I'm not going to avoid America because I might be wrong. And what happens if he's right?
Yeah, sure. We're taking questions as well for Warren Ingram tonight, the co-founder of Galileo Capital on 011-883-0702 and 021-446-0567. Chris has got in touch with a question. He says, I'm self-employed, but I need to save for retirement. I don't like the idea of having my money stuck until a certain age, so I'm reluctant to use a retirement annuity. Are there other investments I can consider? Chris, we'll have an answer for you in just a moment. 9 minutes now to 8.
The Money Show. Personal Finance with Warren Ingram.
And of course, your cause for Warren tonight. So Chris's question, he's self-employed, needs to save for retirement, doesn't like the idea of having money stuck until a certain age, doesn't want to use a retirement annuity. Warren, what other options does Chris have?
Well, we can't let him get away with the retirement annuity dismissal so quickly, Stephen. We've got to talk about it because, for the last couple of weeks almost, government has done something very good, which is they've reformed the retirement sector in South Africa and actually allowed people to access some of the money, not a huge amount, but some of the money in their retirement annuities. So it means that Chris's point is possibly not as correct as it was a year ago. You can now access a bit of money in your retirement annuity. And I think it makes retirement annuities a lot more attractive to people who had this one concern of Chris's, that the money was locked away. So I'm actually going to say, Chris, that for new investors, it's not a bad idea at all to put your money, some of your money into a retirement annuity, knowing that you can access a portion of it in the months and years ahead. And the idea there, of course, is that we don't want you to do that because you're going to pay a huge amount of tax if you take the money out. But you get such a big tax break for putting the money in that I think it is something to consider. Equally, for entrepreneurs, for people who are self-employed, you get quite a lot of protection from creditors about when you put money into a retirement annuity. So please don't just dismiss it. But if you don't like my argument so far, Chris, then consider tax-free savings accounts, because it is what it says on the box. You put the money in, you get no tax deductions for making your contributions, but all of the growth of the money that you invest in your tax-free savings will be free of income tax, free of dividends tax, free of capital gains tax. So a very nice long-term investment. And certainly, I think it's kind of a no-brainer for people that have a time horizon of 10, 15 years or longer to at least max out their tax-free if they're not going to do retirement fund contributions. I like the idea of doing both, but gee, you've got to consider tax-frees if you're not going to do the RA as well. And then, taking a long-term investment, either in a general equity unit trust or a index tracking exchange traded fund as another alternative. The tax rates will be very low. You're going to pay capital gains tax, but at least you're not paying income tax or tax on rent or anything like that. So those would be my kind of good suggestions for Chris. But I'm going to challenge you to go and think about your retirement annuity views there, Chris.
Sure. When you talk about uncertainty and risk, you also talk about cost averaging. In other words, you talk about sort of managing that using cost averaging.
So when the world is up and down, and let's use a live example. We look at the American stock market. It's done incredibly well, primarily because of a handful of very big tech shares. And so if you're sitting here with a lump sum of money that, a portion of which you'd like to allocate to the American market, it doesn't necessarily make sense to allocate all of that money to the American market in one big lump sum. So what you should really think about doing, especially when markets are expensive, is take your lump sum of money, divide it into 12, and allocate an equal amount of 1/12 every month for the next 12 months. So take your, I'm not going to do the maths because it's too late and I'll probably get it wrong, but take your money, divide it by 12 and say 1/12 every month, whether it's the first week of the month or the last week of the month, it doesn't matter. Just pick a time and do that consistently throughout the year. If the stock markets crash at the early stage of your investment, then the bulk of your money will be buying into the markets as they go down, which is very good. It means you're getting a discount on your investments. However, if the markets continue to do very well, then at least a portion of your money was invested at the start of the year, and by the end of the year, you've got some of the money going in at the end. So phasing in is a very good strategy.
I mean, it's really interesting. But the whole point, I suppose, is that investing is about trying to predict the future. And that's what makes it so interesting. It's not just that it's so important. It's so interesting. You have to actually learn to manage the volatility. And that's a really interesting intellectual challenge. It's, I presume, why you still do it.
100%, because we're never going to get this perfect. We are by definition, imperfect as human beings, and the wiring of our brains, unfortunately, makes us terrible investors. So we constantly have to fight our innate instincts, which are fight or flight, and both of those are really bad for helping you make rational decisions. It's very good to avoid an animal that's trying to kill you, but not so good when you have to say, well, what's the prospects of a company delivering great returns over the next 5 years? And so in that instance, fighting your emotions is a very good call, and you can't do it, in isolation. You've got to develop a long-term strategy and try and find a way to give yourself kind of guardrails to make sensible decisions when the world is uncertain and you're emotional, and at other times don't get too excited and try and stay calm and see what you can do. But the real trick here is think about these things in 10-year periods and not 2-week or 1-year periods.
Warren Ingram, thank you so much. Really appreciate it. Personal Finance with Warren Ingram, a certified financial planner and co-founder of Galileo Capital. How to thrive in uncertainty.